Well, welcome and thank you for tuning in to the advisory group's education on using your access to the 401k plan. Now, whether you're getting ready for retirement or your career is well along, and maybe you're just in a pivotal time on where you need to look carefully at what the future holds, we feel that the tips and techniques that we will cover in this session can help set the stage for you to reach financial success. First, let me do some quick introductions. My name is Brent Beverly. I'm the president of the advisory group. Working with me during this session is Manny, one of our longtime experienced advisors. With my business partner of decades, Chris Lee, the three of us are certified financial planners. And while we're the lead advisors for the advisory group, it is our tag team that really makes the advisory group shine. We operate a team support for all your activities. We refer to ourselves as the tag team. Tag of source stands for the advisory group. At our firm, we partner with our clients and believe that an educated client is our best client. While we'll always try our best to help you when it comes to your finances, we believe that knowledge is power. One of our missions is to share with our clients any knowledge that can help them make informed decisions. Now, we believe the more you know, the more you're going to like what we do and how we do it. Let's go over the topics of discussion for today. These are the topics we're going to be going through. So first of all, why use a 401k? We really like being able to use 401ks. Why? We're going to talk about investment fundamentals. We're going to focus on things that you can do to perhaps make this work better for you. And then we're going to deal a little bit with your foundation. We're going to talk about that and what that means in a minute. But we're going to talk about your cash flow, how to make sure that this is going right and doesn't come back to bite you later. We want to make sure that you know about emergency reserves and how much you should have there. And finally, we're going to spend a few minutes on estate documents to make sure you've got things taken care of in case of an emergency. Now, we won't go through these in great detail because we don't have a lot of time here, but we're always happy to meet with you to discuss your personal situation and how to best do that. Now, we particularly enjoy passing this information to younger folks, so you may have heard someone exclaim, "If I only knew then what I know now, think how much better things would be." Our goal is to make sure that we give that knowledge so that in 10 or 20 years, you're not making that statement, and you can feel free to share this with someone else who might be a little younger and needs to know this information. Now, to get us going, let me bring up Mr. Chinche. Manny?
Thank you, Brent. Now, many people are under the false assumption that financial planning solely focuses on retirement. And we believe that financial independence is the more accurate term to use. And that is just one of various considerations, and even that is usually misunderstood. Now, most people have three likely sources of income to meet their obligations and expense needs in retirement. And when I say obligations, I'm referring to bills and other required expenses. There are three sources of retirement income. Now, traditionally, we refer to these three sources of income as the triad of retirement sources, a three-legged stool to provide financial support for people in their retirement. The first leg is Social Security. Now, despite headlines in the media, we do not expect the system to completely go away, even though it is depleting the funds that have been built up over the years, because it is simply a public benefit that's too heavily relied upon. On a side note, currently the full retirement age at which you are provided with unreduced Social Security retirement benefits for anyone born after 1960 is age 67. Now, the system is facing tough challenges. Each year we send out a summary of the Social Security Trustees Report reminding us that Social Security is in trouble and that by mid-2030s, if nothing is done, Social Security benefits are likely to be reduced by approximately 25%. That's pretty scary. Now let's put that in real terms for you. The mid-2030s only about 10 years away. Anyone here planning to retire in the next 10 years or later? Or anyone living on Social Security now? What would happen if they saw a 25% cut in their Social Security income? So if the system is to remain at its current pace, actions are going to have to be taken. Now, naturally, we would expect the full retirement age to increase, so you have to take Social Security later in life. We may also see benefits decrease. Now, all of this says you probably do not want to depend on Social Security to be the primary source of your income during retirement. The second expected source of income of that three-legged stool, pension plans. Now, once upon a time, fixed retirement pensions were very common. In those days, you spent your career with one company, and upon retirement, you were given a gold watch and hopefully a fixed monthly pension for life. Now, those are more and more rare now, especially in the private sector. Transitioning from one job to another is quite common now, so tenure is not the typical model of employment that it once was. So what has happened here? The whole employment picture has changed. Most companies now provide employee-funded pensions primarily from salary deferrals, the most common of which are 401ks. Now, different industries have different plans available, such as 403bs, SEP IRAs, or simple IRAs, and some of our participants today may actually work somewhere else. Now, for our purposes, we will refer to all of them in this webinar as 401ks. So while flexibility to move from one job opportunity to another has increased, the responsibility of setting up and funding a retirement pension has now been bestowed upon you. Your 401k can follow you wherever you go, and various investment vehicles are consolidated with future 401ks should the employer allow it. Now, we consider 401ks and other direct contribution plans through work as part of the third leg of the stool, the investment leg. The third leg is what you put away for yourself. It requires you to be proactive and direct excess cash flow towards your own investments. There are various types of investments with different suitability features that are designed to help various needs. And this is why we meet with us. We ask an abundance of questions regarding your personal situations and circumstances so that we know we are making appropriate recommendations. Back to the Social Security system for a minute. For most people, it's mandatory. As for a 401k, once you flip the switch and get it going, your deferral is funded automatically, and they require minor diligence to keep moving forward. Many companies even match a portion of your contribution to help you with your retirement savings. Personal or private investments, however, require the discipline to save that excess cash flow and write the check to transfer those funds to the appropriate investment, knowing that you may very well be sacrificing short-term discretionary satisfaction for long-term prosperity. Now, the key point from these sources is that you need to take care of yourself. Do not count on the government entitlement programs to take care of the bulk of your retirement needs. The sooner you're able to begin, the smoother the ride will be. Focus on why we like to use your 401k as part of your retirement income picture. Now, first of all, who here enjoys paying taxes? Do you want to pay more in taxes or less? If anyone says they want to pay more taxes, remember, you can always add more to your tax payment. The government is happy to take additional funds. Financial transactions and decisions may have tax consequences, some far more severe than others. And we're going to explain some ways to minimize those tax hits, all perfectly legal within the tax code. Now, your 401k allows for both tax-deductible contributions and Roth 401k contributions. We will go through the differences to consider here in a few minutes. Both plans, you get the benefit of tax deferral on the growth of your assets, typically even more important while you are in your higher earning years. Who likes free money? Your company matches a portion of your 401k contributions. This will be money you're not getting if you're not contributing to your plan. And your plan is a broad selection of investment alternatives. Now, note that you're not limited to just one or two alternatives. You have many investments from which to choose. And we're going to discuss ways to use these investment alternatives later in our presentation. Of course, no program is perfect for everyone. You need to make sure that what you're doing with your 401k fits your needs and your personality. Now, some of the things to be aware of. When you pull funds from deductible contributions and growth, you are going to be paying taxes on those at your tax bracket at that given time. If you're under age 59 and a half, there are likely to be tax penalties as well. There are ways to take funds earlier, but for planning purposes, we generally go with the case that pulling funds before age 59 and a half will incur both taxes and penalties. While you're in your company's 401k, you are likely to have restricted access to your funds, even if you're willing to pay the taxes and possible penalties. So if you plan to use the funds in just a few years while you're actively employed, you probably do not want to tie up those funds into a 401k. Assuming you do want to participate, the government doesn't want you to take too much advantage of a good thing. There is a limit to the maximum you can contribute. For 2024, that is $23,000. Now, if you're over age 50, the government has provided you with an additional catch-up amount that you can add to that $23,000. This additional amount for 2024 is $7,500. Typically, these amounts are increased to help keep up with inflation each year. Now, these contribution limits do not include the company matching payments. And as with any government-approved programs, there are additional possible restrictions, especially for highly compensated employees. So you may get additional information from your human resource folks if these provisions affect you. So what's important for you to focus on today are your tax brackets, the basis of income taxation. We'll look at those figures here in a minute. As you make more income, not only do your taxes go up, but on additional dollars above a certain level, the rate at which you are taxed also increases. The most relevant number is your marginal tax bracket. In other words, what rate you pay out in tax on the next dollar you earn. Many people, when they start out in the workforce, fear that a raise will put them in a higher tax bracket under the false assumption that their entire income gets taxed at that level. In reality, only the extra income at or above the bracket gets taxed at the higher percentage. Now here's a chart of the 2024 federal tax rates. There is a stair step of rates, and you only pay the higher tax on the portion of your income that actually goes into that higher tax bracket. In other words, any income you have coming in that is taxed at the 10% raise is always taxed at 10%, even if you have enough income to be paying 35% on some portion of your income. If you have some income taxed at 35%, you will have portions of your income also taxed at 32%, some at 24%, and so on, all the way down to some taxed at 10%. As a single taxpayer, you have a standard deduction for 2024 of $14,600. This means that for the first $14,600 that you earn, you are not paying any federal income tax. So if you make $24,600, you're only paying 10% federal income tax on about $10,000 of your income, which comes out to about $1,000 in taxes. For folks who are married jointly, well, the standard deduction goes to $29,200 before they start paying any income taxes. Of course, these figures do not include the other income-based taxes you pay, such as Social Security and Medicare taxes or state taxes. Three ways to save on taxes. If you're able to put money into a tax-deductible pension plan, like a 401k or IRA, those funds are deducted at the highest marginal tax rate that you pay. If you're in the 33% tax bracket and you put $100 into a pension deferral plan, your income only changed by $67. The other $33 came from taxes that you no longer have to pay this year. Your contributions, if eligible, are deducted from your income. There's tremendous advantage to these tax-deductible contributions. Another advantage of pension plans or IRAs is that while they grow, you do not pay tax on any growth. Dividends and interest that the underlying mutual funds or stocks pay don't subject you to an annual tax form. The term for this is tax deferral and is another huge benefit of a tax-advantaged vehicle. The government makes these advantages possible not out of the goodness of their heart, but to encourage you to fund these retirement assets and become that much less reliant on them in the future. The third way is to have the distributions come out tax-free. For example, if you have tax-free bonds, the earnings may be tax-free. Distributions from a Roth IRA or Roth 401k are tax-free. Principal where you have already paid tax typically comes out tax-free. Now, the best you can do here is 2 out of 3. And if you're not careful, you may only get 1 out of the 3. For example, your typical bank account is not deductible. nor is the interest you earn deferred. But when you use the money at the end, you've already paid tax on the principal and earnings, you get your distributions tax-free. You get one of these advantages. For a traditional IRA, you can get two out of the three. You get the deduction when you put the money in, have tax deferral while it grows, but you get to pay taxes when you withdraw the money. The underlying investments, another decision for you to make is what investment vehicle to use. Pension plans such as 401ks or IRAs are tax advantaged, in most instances allowing you to deduct your contributions from your income and deferring taxes until withdrawal. These are huge advantages, which is why we look to cross these off the list before venturing into non-qualified or taxable investment accounts. Now, sometimes we get calls from people asking us if we can help them open a brokerage account where they can buy tech stocks. But if we get to know them and come to find out that they're not contributing to the 401k at all or as much as they should be, we steer them in that direction instead because it provides such a greater advantage. Now, pension plan matching is also a huge advantage. Who here likes free money? If your employer has a proposition of, for example, matching 100% of your contribution up to 3% of your salary, that could be thousands of dollars that they will be added to your 401k. This is why we focus so much on pension plans being offered by your employer and encourage you to defer as much of your salary as possible within the maximum guidelines. An advantage of a 401k is that it is funded by taking money out of your paycheck, so you don't even have to think about it. Unfortunately, no plan is perfect. One caveat is that you have very little control over the investments. Now, you may be presented with a diversified yet very limited list of investment options from which to choose, and as advisors, we're happy to make use of them and provide you with recommendations. The other concern is that your employer-controlled pension may be locked up for a period of time where you cannot make changes or take withdrawals. We've seen this be a significant problem several times, especially in cases where the company had problems and many of their employees had company stock as part of their 401k investments. Now, assuming you qualify for an IRA, this is also a valuable tax advantage vehicle. This will be especially appropriate if you do not have matching at work or you don't exceed the income thresholds to both your company plan and contribute to such an IRA. And IRA also has the advantage of allowing you to control the investment. You can control the timing of the funds going in or transferring between investments. You can select the investment managers who best fit your needs, not just among a handful of managers selected by your company. And as we move to the third very broad vehicle, we look at what we refer to as non-qualified investments. Those without the valuable tax advantage vehicles, giving you the greatest flexibility and control in the short term. Unfortunately, it also hits you with the highest taxes. If your investment is generating dividends and interest throughout the year, you're going to receive a 1099 and pay for that income accordingly. So if you've exhausted the limits on the pension plan and the deductible IRA and still have excess cash flow, certainly discuss with an advisor ways to make those funds work for you. Non-qualified investments are also appropriate for additional liquidity prior to retirement. As we promised earlier, let's take a look at traditional versus Roth 401ks. Now, a traditional deductible contribution method holds the advantage of allowing you to deduct any money contributed from your taxable income so that you avoid taxation on those funds until you pull them out of the plan and spend them. Down the line, when you take money from your IRA to spend, you will add that income to your taxable income for that year. A Roth provision provides that you pay taxes on your contribution now, preventing any tax deductions. So you're taking after-tax dollars and funding the investment. And if you meet the criteria, you can withdraw them tax-free in the long run, no matter the growth. This is a huge potential advantage. Now, since you could do the same investments in either format, rates of return along the way do not differentiate which method is better. To determine which is more appropriate, you need to look into the future and estimate the tax brackets when you plan to pull funds out of your pension or IRA and compare them to the tax bracket you are in today. This is really the only calculation that matters. Are you in a higher tax bracket now, or are you going to be in a higher tax bracket in the future? Typically, during your working years, you'll be in a higher bracket than during your retirement years. If you're not sure, we recommend taking the current deduction. Our feeling is a bird in the hand is worth two in the bush, and we simply don't know what legislation is going to be decades down the line. Major risks to your financial independence: taxes and inflation. And we've talked about taxes, so now let's direct our focus to inflation. Inflation is quite simply prices going up over time. A house in Orange County, California used to cost $20,000 as recently as 50 years ago. Today, you probably can't even remodel a bathroom in that same house for that price. Your assets face significant inflation risk, susceptible to losing purchasing power because of long-term purchase price inflation, as history has shown us. In our examples and planning scenarios, we generally use a 3 to 4% average inflation rate, which is slightly lower than current inflation, but we simply don't know what the future holds. Now let's take a look at a simple example of inflation by looking at the increasing cost of Disneyland admission over the years. In 1955, you could enter the park for $1. By 1975, this had increased 6 times to $6. 10 years later, in 1985, even that had more than tripled to $19.50, and then nearly doubled from that figure to $37 in 1995. The cost today is as high as $184 for a one-day park hopper ticket. Just for the record, it is hard to get 2024 Disneyland tickets and a reservation for the parks. Costs go up over time. Of course, in the Disneyland example, we're talking about a discretionary expense. If it gets unaffordable for someone, they simply don't go. Not exactly a medicinal product or something we require for survival. Now, one of the fears people share now is that the massive amounts of money the government is flooding into our financial system may cause high inflation later. This is referred to as expansionary policy because the intent is to expand economic growth. But by doing so, however, we may be putting future prosperity at risk. The average inflation figure of 3.4% sounds pretty low, but it is a compounding number. During the 1970s, the United States saw double-digit inflation. That is inflation rates over 10%. The big question then becomes, how do you keep a lifetime of income coming relevant when the cost of living keeps going up? In other words, how do you keep pace with or even work to exceed inflation?
Well, thank you, Manny. We'll now head into probably the most complex part of the presentation here by covering investment fundamentals. Investing 101 tells us there's a simple formula to being a successful investor. All you have to do is buy low and sell high. Well, right, okay, buy low, sell high, that's pretty easy. Well, the problem is no one knows when the market is high and when it is low. Ever. Now, we speak with highly qualified industry professionals on a regular basis, and we still hear conflicting opinions on where the markets are headed, and they each have great supporting evidence for their case. These are leading indicators that we're aware of, historical trends, technical analysis, but in the end, if all of these practices were a certainty to selling at the right time, well, everyone would be a millionaire. So let me say it again. No one knows when the markets are high or when they are low, ever. So what's the best advice we can give you in this regard? Number one, don't try to time markets. The markets will fool you constantly. Now we're going to take a look here at how even a rock-solid economic environment, investors' emotions can cause them to do the wrong thing. So let's look at it. How should you? Let's discuss some very basic investment fundamentals and how the world really works. First of all, history has provided us great evidence that markets go up and markets go down, but over time they tend to go up. Since no one can time markets, we need to have a real plan for investing. Market corrections and collapses are common occurrences, but no one knows when they're going to happen. They're unpredictable. Not all investments are alike. Some investments are riskier than others. Now, we talked about risk earlier. Some investments are just more volatile in the short term than others. Other investments may be more stable in the short term, but face that loss of spending power in the long term. And you'll hear this again, but let me say it here. There is no single investment that will fit all of your needs. You have to have diversified investments. By diversifying your investments in a mix that fits your needs and your goals, you can help control your investment risks. So diversification helps manage risk. Different markets go up and down at different times. So, for example, U.S. markets have outperformed international markets for the last decade. What's going to do better in the next decade? Hey, no one knows. Moreover, there's no single investment that's suitable for every investor. This is why we recommend that you review your circumstances, goals, and feelings of risk, and that way we can recommend investments for you. So what's the greatest problem that most investors face? One word: emotion. Most investors get emotional about their investors. I alluded to the fact that most positive economic data and headlines can't overcome investors' emotions. A company could be prospering tremendously with people rushing to buy it, but the CEO were to get caught in a personal scandal, investors may shy away and that company sell out, and the market would drop accordingly. It's just the way things happen. What we have here is the more traditional and more common emotional cycle as it relates to investing. Now, we see many investors experience disappointing returns because they have an emotional, undisciplined approach to investing. You can see the quote at the bottom by investment writer Robert Arnault. In investing, what is comfortable is rarely profitable. So let's look closely at this cycle here. This is crucial. As you begin to invest, you typically start out with that basic emotion of fear. Right? You've perhaps had past recessions, down markets, the thought of losing every dollar you're investing. However, you put a little bit in and lo and behold, your investment goes up, it starts to rise. And pretty soon, you're hoping it goes up, you hope it goes up. Oh man, and it does, it gets way up there. And a new emotion takes over: greed. This is easy money. I can do this. Let's put all of our money in. Let's buy big. Now, what happens the day after you buy big? It's uncanny to me how it just turns around, almost the next day and starts heading down. And pretty soon you're down to hope. I hope it doesn't go down anymore. Hope it doesn't go down anymore. You're hoping that downturn is limited. But you know what? It just continues to drop. And it drops so much that your investment may be back below or down below what you started with. Oh my God, this is going down forever. I got to get out while I've got something left. I've got to get out. I sell. So what'd you do? You bought high and sold low. We just told you the way to make money was to buy low and sell high. Emotion tells you to do the wrong thing. Don't get emotional about your investments. So guess where we think the markets are today? Yeah, well, they're probably closer to the green emotion than the fear level right now. We're hitting record highs. But are they going to go up more? Are they not going to go up? Or really at hope? Guys, we don't know. So we're going to show you some techniques to use to bring logic into this picture. All right. It's a common experience, though, for most investors to get emotional about their investments. An emotional response to volatility and risk can lead to disappointing performance. As advisors, we're here to help you take that emotion out of the picture and take it on in your behalf. And guys, we get emotional too. We're human. And it helps to then talk with someone else who you know has your best interests at heart to help you stay through the picture. Stick to your original game plan. Now, we expect the ups and downs, and we don't respond with knee-jerk reactions during down times. Since we know that markets can be volatile, what are some of the ways to put those market fluctuations to work for you? One of the most common techniques is what we call dollar cost averaging. Now, dollar cost averaging is systematic investing dollars over time on a regular basis. Now, especially with your 401k, you're probably investing new dollars every pay period. This technique may be able to help you easily. Now, I want to make a statement right up front. Regular investing does not ensure a profit and does not protect against loss in declining markets. As an investor, you should consider your ability to invest continuously during periods of fluctuating market values. They're just going to happen. Now, as I said, dollar cost averaging is putting away a predetermined amount on a regular basis. Typically, automatically investing the same amount every month, every quarter, whatever works for you. And it has been a proven way to pursue the accumulation of wealth over time. All right? It encourages discipline. It eliminates the need of deciding when to invest. When it's time to invest, you just put in. It avoids the temptation of timing the market. Some investors simply cannot resist that urge to invest at market lows and take the profits at high. The problem is they usually fail because the market is virtually impossible to time. So let's take a look at this. The object is to invest a set money of time each time. Now, has anybody here been to Vegas? You've been to Las Vegas? Who always wins in Las Vegas? The house, the casino. I used to live there. Trust me, the house always wins over time. Do they win every hand? No. Do they have runs where somebody else wins over time? Yes. What have they done? They have loaded the odds in their favor so that if they stay in the game long enough, they're going to win. Okay? That's what dollar cost averaging helps us to do for you. It helps load the odds in your favor to make it easier for you to win over time. So let's look at a real simplified example here. All right? We're doing a kind of a stock investment, so it's going up and down, up and down. Okay? Let's say you do your first investment when it's at a peak there, $20 a share. You invest $1,000, and at $20 a share, you bought 50 shares. Now, right after you buy, what happens to the market? We already talked about this. It just drops straight down. And let's say it drops all the way to $10 a share. In Las Vegas terms, you just paid a jackpot. Right? But you're following a systematic priority here. You invest another $1,000, and at $10 a share, that bought you 100 shares. Now, most people look at this and they say, well, I bought some at $20 a share. I bought some at $10 a share. Therefore, my average price per share is halfway between 10 and 20, $15 a share. But wait a minute. The mathematicians of the group say, wait, I put in $2,000 and I bought 150 shares. Let's do the math on that. If I did $2,000 invested and divided that by 150 shares, my average price per share is $13.33, almost as if I put in all that money right here near the bottom. The strategy forces you to buy fewer shares when the price is high and more shares when the price was low, and you didn't have to know what the market was when you invested. So what this does is it keeps you from putting everything in at the top. It keeps you from putting everything in at the bottom. All right, it spreads it out. So a couple things to remember here. In the long run, the waves of the market here get outweighed by the tide of the market. In 10 years, the fact that you spread this out over several months or even over the year, probably not going to make a big difference, okay? Just because the markets tend to go up. But in the shorter run, it helps you to load those odds in your favor. The more frequently you invest and the longer you keep investing, the smoother that average share cost line becomes. A market decline may mean bargain prices to purchase unless you're selling shares that were purchased at higher prices. So, in fact, downturn provides an opportunity to buy more shares at attractive prices. shares that have then the potential to go back up. And sometimes you can tell our clients, because when the markets go crashing down, they're out there going, yes, yes, the market is down. Why? Because they're buying. They want the price to go down when they're buying shares. So, but you need to be prepared to weather a sustained market decline. Keep in mind that in order for dollar cost averaging to work, you must be prepared to commit your financial resources and have the resolve to make the contributions on each appointed date, and then wait for the market, as it has historically, over time, pull out and make more money. So let's look at another concept to maybe help load those odds in your favor. Now, we said before, you need to diversify your investments. Don't put all your eggs in one basket. We agree with that. But there may be a way to improve on that over time. Wouldn't it be nice? Now notice our chart here, it's the same up-down chart that you've seen before, but wouldn't it be nice if we could find an investment that went counter-cyclical to that? When that investment went up, the second investment goes down. Okay? They just run opposite each other. But if we're invested in both investments, then we're kind of in the average of those. Okay? Now, there are no investments, I'm here to tell you, there are no investments that do this all the time. But that said, 3 American economists won the Nobel Prize for Economics in 1990 by demonstrating that there are investments that operate counter-cyclically over time. The economists called this modern portfolio theory, or MPT. The investment categories are called asset classes. So you're going to usually hear us refer to this as asset class investing. And recognize we're simplifying here a little bit, and it doesn't work in all instances, but it does give us a guide over time to some of the investments we may want to use. So let's look at the asset classes that the original authors determined work as counter-cyclical investments. And they were large cap versus small cap, large companies versus smaller companies, growth versus value. Now, a growth company is a company that has done well and is expected to continue to do well. A value company is a company that has had its price depressed for some reason. Markets tend to favor one or the other. The next ones are U.S. domestic stocks versus international stocks. That one's pretty easy. The final one is stocks versus bonds. Now, typically when stocks have trouble, investors run to the security of fixed income. In other words, bonds. Now, is this always the case? Of course not. 2022 was a perfect example of how both stocks and bonds got hit. But over time, we tend to see stocks do well in one period, bonds do different in the other period. The other difference to point out here is that unlike the others, which tend to end up in about the same area of return, bonds traditionally earn less than stocks over time. So a little bit different weighting here. And since the study came out in the 1990s, there have been other asset classes that have been developed, such as, say, securitized real estate, alternative investments, such as commodities. And as we've noted multiple times, past performance, not an indicator of future performance, but we feel that using this kind of scientific diversification is better than just throwing All right. Thank you, Manny. I do appreciate it. And as Manny warned you, I view this as one of the most critical subjects that we're discussing today. It's not directly related to your 401k, but it is critical in my opinion. So I'm going to get up on my soapbox here. Every adult should have a will and the associated documents that we're going to discuss here, regardless of their age or situation. And if you don't have these documents that we're going to discuss now, it can cause major problems for you and your family. Please don't do this. So I'll step down from my soapbox now, but you probably already have a will, whether you've written it yourself or not, because your state usually has what's called a statutory will in case you don't have one of your own. Now, you most likely would not be in agreement with what it says. If you have a statutory will, and that's the one that the state provides by default, your estate can get eaten up in legal costs as the courts try to decide what to do with your assets. Now, we like to say, and it's a little bit of an extension here, but we like to say a statutory will gives half of your money to the attorneys and the other half to the state, and your heirs get the rest. Okay, that's an overstatement, but it's probably not too far off. Now, we meet occasionally with people who've written down their wishes on a piece of paper and think that's all they need. A will that is completely handwritten and signed is called a holographic will and could very well be enforceable. But this is usually not a good idea. What seems clear to you when you write it may not be clear when you're not there to explain it. Your wishes could very easily be misinterpreted if they lack specificity and legal terminology. That's why attorneys are around. Now, an example that I like, just a classic example, was a guy who wrote, quote, "I leave everything to mother," and signed it. Now, that seems pretty clear, doesn't it? Well, his ex-wife came in and claimed the money, saying it was hers, saying that he had always referred to her as mother. And in the end, she did end up receiving a substantial portion of his estate. Now, I suspect probably not what he really intended, but we don't know. And that's why it's so important to use an attorney who specializes in this area of law. Otherwise, you're simply creating a disaster for you and your family. Please don't do that. Now, worse yet, in my opinion, there are some do-it-yourself programs out there and online businesses that, get a couple of facts from you and then generate documents. Now, I did this early on. I went out and said, I'm pretty knowledgeable at this. I know I've seen this a lot. I'm just going to get the program and then I can do this. And I spent about 20 minutes in there doing that. And I went, wait a minute. This is just wrong. This is dangerously wrong. And I went and had my wills and other documents drafted by a proper attorney. But most people don't have that level of experience that I brought to it to know that what they're getting is just wrong. It's just going to cause problems. And we're back to, guys, we need to get an attorney who understands this, a qualified attorney, and get what you need properly. All right, I beat on that enough. Let me move on. So we're not going to cover living trust today in any detail. If you need a living trust, the attorney that you're working with will be able to help you do that. Years ago, these were almost everybody needed one. With the current laws, not so much, but if you need one, the attorney will help you to get one and help you specify that need. Now, I want to make a quick note here. This is not directly related, but it is important. Investments or policies which have stated beneficiaries are not controlled by your will, or the trust for that matter. Programs such as your IRAs, your 401k is an example, pensions, life insurance, annuity policies, all have where you state the beneficiaries when you set them up or along the way. Now, if the beneficiary you select for the policy or the 401k is person A, but your will says it goes to person B, doesn't matter. Person A is going to get the money. All right. Now, there are other conditions that you should be aware of when stating your beneficiaries. Per stirpes as an example, or other things. Be sure to discuss this with your attorney when you set up your will so that you've got it right. Now, there are other documents that you need. Maybe you're not dead. The will only kicks in when you're dead. What if you're disabled? What if you're not able to make decisions for yourself? Well, guys, you need this. So this list was provided by Texas Law because we're doing this webinar for people in Texas. All right. The documents that you have here: directive to physicians, medical power of attorney, out of hospital, do not resuscitate, DNR, durable power of attorney, the HIPAA release, all important documents. If you're in California, adults need to have your own will, advanced healthcare directive, durable power of attorney for asset management, HIPAA release. Guys, see your attorney. Now, if you need assistance in preparing to see the attorney, we have some documents that kind of help you formulate your thinking and put things down on paper so that you can do that. We're happy to provide that to you to help you meet with the attorney. All right, but we're not attorneys. These documents aren't legal documents. They're just a way for you to organize your thoughts. If you need those kind of documents, by all means, reach out to us. We're happy to give you some preparatory documents. If you need a referral to an attorney, perhaps we can help there too. But most important is to find an attorney in your state who's most knowledgeable. So just some closing thoughts here on this. All right. There are many factors that consider before making your investment decisions. All right. It's not just, hey, everybody needs to do this. It's what works for you. Do you have the reserves? Do you have the documents? There's no one size fits all approach on this investing. Are you going to pay taxes now, pay them later? Is it long-term or short-term? Is it volatile or guaranteed? Is it a portfolio or single investment? It's different for everyone. And the sooner you get your plan in place, the smoother your path is likely to be. So where do we go from here? Now, we realize that this is pretty condensed and pretty fast webinar, and there are other topics we wish you had time to cover or cover in more detail. We encourage you to examine your personal circumstances and establish an appropriate plan, no matter your age, that will allow you to meet your goals and will help you set your goals. We realize the circumstances for each person is different from everyone else's. So we're happy to provide you with individual guidance and recommendations to not only see where you currently stand, but help you to determine the necessary steps to have the pieces in place to help you reach your goals. We want to get your financial life started appropriately. We want to get it right the first time. So what can you expect from the advisory group? If you sign up with the advisory group, you can expect constant communications. Now, many of our clients view us as a filter for the deluge of information that is out there to allow them and help them to focus on what it is that's important to them. The information out there, once we pull that together, we'll get it out so you can catch up on focused items. Then we have frequent discussions or meetings such as this, where we allow people to pull it together and understand, here are the things out of all that news out there, here's what to focus on. Here's where we go. And we're constantly reviewing economic, tax, estate, investment issues for our clients to help them sort out what's going on. Now, we will not send you any of this valuable information unless you ask us to. Unless you give us your name and email address, we won't be sending this to you. All right? But we're happy to send it to people who want to receive this information. So if you're not an existing client, please reach out to us. We'll tell you how, and we'll give us your contact info. We'll be happy to include you on our list. We view our role as your advisor to help you determine your own appropriate retirement savings goal. What is it that you need? What's there? What are the factors such as inflation, future healthcare expenses, life expectancy, projected investment returns, your need for spending, all that together to develop an investment strategy to help you address your long-term needs to get it there. If you need a professionally managed IRA, we'll work on that. If you need to use the 401k, we will help you with that. Our goal is to help you balance your retirement savings goal with what you have available to you and with your other financial goals so that you are meeting your long-term goals safely and securely. Our role as your advisor is we're going to be there for you. We maintain a non-emotional, objective view to help you stay unemotional and stay on track. We will avoid knee-jerk reactions. We will assist you in making decisions that are always in your best interest. And biggest of all, we're here for you. When you need us, we're here. That's why we have a team. Now, there's some legal disclosures here. I want to make sure that you have a chance to see these. Okay, we talk about different things here. Please feel free to pause the presentation and read these. Page, same kind of thing. Again, please read these and take your time. I want to thank you for joining me today and going through this with us. If you have any questions or want to continue, want to know more, please reach out to us. This is our contact information. I'm going to let it run for a little while. Here's how you get with us. Now, notice schedule appointments with Katie. She's the member of our team who takes care of setting appointments with the advisors. Our first appointments are always complimentary. We don't charge you. We want to get to know you. You get to know us, how we work, what we do. And if there's a fit, then we'll move forward. No surprises. All right? But if it doesn't work out, if it doesn't work for us, it doesn't work for you, whichever, fine. You just spent some time, got some additional information that I hope you found helpful, and there we go. So that concludes today's session here. I hope you found it informative and interesting, and thank you very much for listening in and getting the additional education. Have a great day.